Hi everybody, welcome to another episode of Blockchain Central. Today we look into Bitcoin Cash. Have you ever wondered why there are two kinds of Bitcoins on your exchange? That's why today I want to talk about Bitcoin and Bitcoin Cash. Bitcoin is almost like a dinosaur of blockchain. It was the first fully functional distributed ledger network, and it hit its all-time high in December 2017. With a valuation of nearly $20,000 US. But as it is the case with new technologies, Bitcoin too has run up against its limits in terms of scalability and transaction rates. In the current Bitcoin network, one block is limited to 1 megabyte in size and is created around every 10 minutes. This yields a maximum transaction ratio of 7 transactions per second. As the network gained more attention, more and more transactions were issued into the network. With a limit of 7 transactions per second, unvalidated transactions started to pile up. In May 2017, users reported a waiting time of 4 days before the deal was finally settled in the network. If users wanted to speed up their transactions, they had to pay a very high transaction fee, which makes Bitcoin very unattractive as a payment method. Imagine you want to buy a cup of coffee, which cost you $3, but either the transaction fee is $15 or it's 4 days before you get your coffee. For comparison, Visa can handle up to 56,000 transactions per second in peak times. The scalability issue is well known in the Bitcoin community, and discussions aimed to resolve that issue have been going on since 2013. Since Bitcoin is an open and globally distributed network, it is used by various groups who benefit from the blockchain in different ways. While each of these groups has a vested interest in Bitcoin, none of them have a sole decision-making power over the upgrade process. Therefore, a discussion evolved into an ideological battle over the future of Bitcoin, from which two opinions emerged. One was centered around the Bitcoin core developer team, which prefers off-chain solutions like the Lightning Network. In their opinion, a change in the Bitcoin block size, resulting in a hard fork, violates the code is law principle, which according to them is one of the main achievements of blockchain technology. One way to avoid a fork is to apply the segregated witness technology. Segregated witness, SegWit for short, essentially updates the transaction data format, increasing the amount of transactions which fit into one block. Furthermore, the implementation of SegWit allows scaling innovations like the Lightning Network. In a Lightning Network, two parties open a transaction channel, through which various transactions can be conducted. At the end, only the final balances of the channel will be settled via the public ledger, saving time and computational validation power. But there's of course another possible approach. The second group wanted to simply increase the block size in order to fit more transactions into one block. This disagreement between the two parties yielded a hard fork of the Bitcoin blockchain. The entire process of a hard fork can also be described as a user-activated hard fork, meaning the new blockchain has the same old tail, but one point, starts to use a new consensus rule, creating a new network with only its own miners. And that's exactly what happened in August 2017. One part of the Bitcoin community announced the fork, creating Bitcoin Cash. Bitcoin Cash wants to fulfill the original promise of Bitcoin as peer-to-peer electronic cash by providing low fees and a fast, reliable confirmation network. All Bitcoin holders until this block also own the same amount of Bitcoin Cash. Bitcoin Cash itself uses an upgraded block size, which at first allowed up to 8 megabyte blocks and was further increased in May 2018 to 32 megabytes. This increased the possible amount of transactions per second while decreasing transaction fees. The development team behind Bitcoin Cash also announced that they will adjust and perform necessary changes to the network twice a year to keep Bitcoin Cash up to date. Interestingly, Bitcoin Cash solely provides an on-chain scalability solution and does not support SegWit or Lightning. However, the upgraded block size is in no way close to the 56,000 transactions which Visa can handle in the peak times. Therefore, one can argue that Bitcoin Cash is faster than the original Bitcoin network, but still does not entirely solve the scalability issue in the long run. Apart from the potential advantages of Bitcoin Cash, the entire project came with harsh critique by the Bitcoin community. First of all, larger blocks require more computing power and memory power, and thereby outprice smaller miners. This brings a potential threat of a large mining conglomerates centralizing the decision-making process for Bitcoin Cash. Secondly, everyone holding Bitcoin before the split receives the equal amount of Bitcoin Cash tokens. Therefore, the hard fork raised concerns of being a money-making scheme. Overall, after initial difficulties, investors seem to accept Bitcoin Cash. It is currently the fourth strongest crypto token in the terms of market capitalization. Time will tell whether Bitcoin Cash really persuades the majority of the Bitcoin community to use it and whether it becomes the new global payment currency. Now you know the difference between Bitcoin and Bitcoin Cash, and you can decide yourself which one might have a bigger potential. That's it for this episode of Blockchain Central. Make sure to hit the like button if you like this video, and don't forget to subscribe to Blockchain Central to never miss a beat. Happy investing.